Hello and welcome to another session of the My Solo 401k Financial, My Community Daily Webinar Series. We're going to go through some slides today focused on self-directed 401ks. As always, the presentation is being provided for educational purposes only and should not be construed as tax advice or legal advice. We never discourage you from discussing this with your financial advisor, with your tax advisor, with your legal advisor, etc. If you're on YouTube, please like and subscribe. If you're on YouTube, also feel free to chat over questions. Or if you're on any of the other social channels, you'll be able to chat over questions like on LinkedIn or Twitter. You can always find us on our community, mysolo401k.net/mycommunity. You can always find our webinar schedule at mysolo401k.net/webinar. We go live twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern, and then we're back again at 1 p.m. Pacific, 4 p.m. Eastern. Please subscribe to the YouTube so you can get all the notifications. For example, tomorrow in the afternoon session, we'll be back with some great deep dive content going over A to Z contributions, the 2024 and 2025 contribution rules for a business that's taxed as an S Corp or a C Corp, or it could be an LLC taxed as an S Corp or a C Corp. So we're going to go through it A to Z, examples, how to report contributions. It'll be a lot of great content. If you can't join, you can always just submit the email through the links at mysolo401k.net/webinar. And this is the kickoff, really, of the contribution season. So we'll be having a lot of these deep dive webinars on these types of topics, as well as mega backdoor Roth, as well as the magic number. In other words, how much income you need to be able to justify contributions. So if you subscribe to YouTube, you get all the notifications. You can join live, you can ask questions, etc. So yes, self-directed 401k plans. Let's spend a moment talking about that after we lay some foundation, which would be eligibility. So a solo 401k plan is really for self-employed individuals that have owner-only businesses. So think like an independent contractor, a solo practicing professional, like a medical professional, or a CPA, or a realtor, or an attorney. The key is that you report earned self-employment income on your taxes with no non-owner, non-spouse, full-time W-2 employees. So that means if your spouse is working in the business and reporting their own earned self-employment income, you could still have a solo 401k. That means if you have contractors, regardless of how much they work, if they're true independent contractors, that's not going to prevent you from having a solo 401k. But if you have non-owner, full-time W-2 employees, in other words, employees that work 1,000 hours a year with a year of service, or 500 hours a year for 2 consecutive years, well, that business is not going to be able to set up an owner-only plan. It would have to set up a 401k plan that could accommodate those non-owner employees. And that's mean it's going to be a more vanilla plan, right? In other words, it's not going to allow for alternative investments like crypto or real estate. It's not going to allow for checkbook control. It's probably not going to allow for, it may allow for Roth, but it's not going to really accommodate the mega backdoor Roth because of the way the testing rules work. It may not allow for loans. So all the advanced features that our plan offers and that prompts individuals to sign up with us. So as part of the onboarding process, we help our customers open up accounts at the bank or brokerage of choice. So you can have both bank and brokerage accounts as well. Top brokerage options are going to be Fidelity, number 1, Schwab, number 2. So these are free brokerage accounts. The brokerage firm doesn't charge any fee to set it up. So it's free to set up. There's no maintenance fee. They even offer a free online checkbook or free online trading, and then a free checkbook associated with that account. So in addition, many customers want to have a bank account, especially those that want to invest in alternative investments. Why? Because now they can access not only their funds via a checkbook, but also certified checks, ACH funds in and out of the account, even debit card access. So if you're looking to invest in real estate, a lot of times based on experience and client feedback, those additional ways to access the money can be super helpful. The way that you get money into the account is either by making contributions and or rolling money over from an eligible retirement account, a pre-existing retirement account, like an IRA, as long as it's not a Roth IRA, or a former employer plan. Again, contributions, though, is another way. The solo 401k plan has the highest contribution limits for any defined contribution plan available to self-employed individuals. And then on top of that, our plan not only allows for pre-tax contributions, but also allows for Roth as well as mega backdoor Roth contributions. So a lot of folks are doing combination objectives. In other words, they want to make mega backdoor Roth contributions to maximize the money going into the plan. But then once the money's in the Roth account, invest in alternative investments. It could be crypto, it could be real estate, it could be notes. So if you're going to make mega backdoor Roth contributions, that's where you need to have the multiple accounts set up. So it's one plan, one fee, but different accounts associated with the plan, right? So one account in the name of the plan for pre-tax money, a second account in the name of the plan for Roth money, and then a third account for voluntary after-tax funds. Because when you're making a mega backdoor Roth contribution, it's really a two-step process. You're taking advantage of the fact that our plan allows for voluntary after-tax contributions, and the voluntary after-tax contribution limits are so much higher than your standard Roth contribution limits, right? So you got the Roth IRA limits, which are the lowest. Then if you have a plan like ours, you can make Roth employee contributions, for example, $23,500 for 2025. But then if you have a plan like ours that allows for voluntary after-tax contributions, you can go all the way up to the overall limit, for example, $70,000 for 2025 as a voluntary after-tax contribution. Now, those voluntary after-tax contributions need to go into a separate voluntary after-tax account before they get moved over to the Roth. So that's why you need those different account sub-accounts, which we're very hands-on in helping customers open up those accounts as part of the onboarding process. So back to eligibility, just some of the top quick hitters in terms of eligibility considerations. Do I need a separate entity like an LLC or an S Corp? No, you don't. We have many customers who operate without a formal legal entity, for example, as a sole proprietor. Ultimately, the key is that you need to have that earned self-employment income. There's different ways to report earned self-employment income. For example, if your business is taxed as a sole proprietorship, earned self-employment income would be income reported on Schedule C. If your business is taxed as an S Corp or a C Corp, it's W-2 wages from your business. There's no minimum amount of earned self-employment income that you need to be eligible to set up a plan. Your spouse or business partner can participate as long as they're reporting earned self-employment income. You can have a solo 401k even if you have a W-2 day job, even if you participate in your W-2 employer-sponsored plan. And here's another good slide that it shows you've got 2 participants and there would be 6 accounts. Right. So if you do have that spouse participating because they're working in the business and reporting their own earned self-employment income, and each of you want to make mega backdoor Roth contributions, now you each have 3 accounts for a total of 6 sub-accounts, pre-tax Roth and after-tax for each of you. Again, it's still just one plan, one fee that we charge, right? Self-directed 401k top compliance items. Well, it's only for the self-employed. Number one, of course, that's always the foundation. You got to be eligible. Owner-only businesses, self-employed without any common law full-time W-2 employees. Another important compliance item, you're going to be limited to investing in allowed investments. Now, there's a wide range of allowed investments, but there are still limitations, right? You can't invest in collectibles, right? So you can't invest in a whiskey bottle or a wine bottle or a collectible car, right? Or other things that people might think of as a quote unquote investment. That's not going to cut it. That's not going to satisfy the solo 401k investing rules. But there are many other categories, real estate being a top one, right? This could be single family rentals, multifamily, private placements, raw land, notes, right? Could be secured notes, could be unsecured. Could be precious metals, could be crypto like Bitcoin, tax liens, tax deeds, There's many other examples. Common prohibited transactions, another important compliance consideration. Let's take a couple of example categories. Number one, real estate. So if you invest in real estate, say as a single family rental, really your 401k is buying the property. So the 401k would need to buy the property from an unrelated person, right? So you couldn't somehow sell or transfer an investment property that you may own personally to your solo 401k. Can't do it directly, can't do it indirectly, but your solo 401k can buy an investment property, just has to buy it from an unrelated person. So once that property's in your solo 401k, you can't use the solo 401k as a security for a loan to yourself, right? This is really a separate asset. This is not a personal asset. You can't leverage this asset like you could a personal asset to obtain a loan to yourself. You can't use the solo 401k for personal use. You can't work on the property, right? It's got to be a totally passive investment. Let's also talk about prohibited transactions in the context of a promissory note. So promissory note means the solo 401k lends money and then the borrower promises to pay back the solo 401k. So the loan needs to be to an unrelated person. So it can't be to your parents, can't be to a related business like your self-employed business, can't loan funds to your spouse. Now, one exception to this, of course, would be you can take a solo 401k participant loan, but that's a very specific transaction, right? You're limited to 50% of the balance, not to exceed $50,000. It's going to be paid back in equal payments of principal and interest, either monthly or quarterly. Principal is going to be prime plus 1%. The term's going to be 5 years unless you're going to use the proceeds to purchase your primary residence, in which case you can extend the term beyond the 5 years up to 15 or even 30 years in that case. So why a solo 401k? Well, we touched on some of these organically, but just to emphasize it, a solo 401k with us is going to have maximum flexibility, maximum options and features. One of those top options are alternative investments, right? As we talked about, in order to be eligible to set up a solo 401k, you have to be self-employed. Common example is a realtor, right? Or another type of self-employed person. So some of these individuals, right, they feel like they know, say, real estate more, or notes more, or precious metals more, or they want to diversify into these assets, right? They might feel like maybe they're more comfortable with those types of investments versus your traditional Wall Street type investments like mutual funds, etc. Some folks do want to have some money invested in those Wall Street type investments through, say, a brokerage account like a Fidelity or Schwab, but they also want to put some of their solo 401k funds into alternative investments. And then practically having that checkbook control, that wire control, gives the individual quick access to their funds so they can take advantage of investment opportunities, right? As the self-employed individual, they can serve as the trustee of their solo 401k. So they can have that direct access to that bank or that brokerage account, that direct checkbook or wire access to quickly take advantage of investment opportunities. We touched on the disallowed investments in terms of some of the compliance items, right? Works of art, collectibles, stamps, gemstones. These are all things that are disallowed investments. You can't invest your solo 401k in these types of investments. Now, you may have an allowable investment, but you have a disallowed person, what they refer to as a disqualified person. So real estate as a category generally is allowable, but you can't buy real estate from a disqualified person. So this is going to be people up and down the family tree, right? So your parents, your children, your spouse, entities controlled by a disqualified person, like your own self-employed business, right? We talked about it in the context of a loan. So top reasons, we talked about investments and some of the prohibited transaction considerations. The fact that the solo 401k has the highest contribution limits for any defined contribution plan. And our plan allows for all types of investments. So not only pre-tax contributions, which gives you that benefit of reducing your taxable income now, but also Roth and mega backdoor Roth contributions, where you've got that potential for tax-free growth when it comes to the growth on that investment. So in terms of those highest contribution limits for any defined contribution plan, for 2024, the overall limit is $69,000 or $7,500 if you're 50 or older. For 2025, it went up to $70,000. The catch-up contribution limit stays the same, but now they've added the super catch-up contribution limit. So instead of $7,500, if you're age 60, 61, 62, or 63, it goes up to $11,250 for, so somebody that's in that age group could contribute up to $81,250 to their solo 401k for 2025. So it's a great way for somebody who might be behind on their savings goals to catch up. So participant loans, another top feature or reason why customers will want to set up, another top use case. So it's the benefit might be access to emergency funds. So unlike, say, an IRA, where you can't take a loan from any type of IRA, if you have a solo 401k plan like ours that allows for loans, the solo 401k participant can borrow up to 50% of their balance, not to exceed $50,000. Can borrow up to 50% of their balance, not to exceed $50,000, and use the proceeds for any purpose whatsoever, right? Could be a personal purpose, could be an investment purpose, could be paying back credit card debt, really anything. All right, self-directed solo 401k loan requirements. So this is a great slide as it shows the documents, the rules, breaks it down A to Z. So when you take a loan from your self-directed solo 401k or self-directed 401k, like our self-directed 401k plan allows, it's not going to be subject to taxes or penalties as long as it's, number one, documented as a loan. So we handle the loan documentation requirements as part of our services for no additional charge and paid back according to those loan terms, which we talked about up above, right? So we have an online application the customers use to let us know that they want us to prepare the loan documents, and we turn them around within 1 business day. So that's going to be things like the loan agreement, the payment schedule, right? The amortization schedule. So it's an online form. It's not a true application in terms of there's no credit checks, there's no approval process, there's no underwriting process. Now, the rules are paying it back, right? So it's got to be documented and it's got to be paid back according to the terms, right? So those payments are either going to be monthly or quarterly. It's up to you. You'll choose that in that online form. Paid back within 5 years. Those monthly or quarterly payments are equal payments spread over a 5-year term, or it could be longer, only if the proceeds are going to be used to purchase one's primary residence. So if you're just using it to upgrade your primary residence, you're going to be at the 5-year term. Can't be more than 50% of the balance, not to exceed $50,000. Interest rate is either prime plus 1% or a CD rate plus 2%. Another great feature of our plan is you can transfer funds. You can consolidate from pre-existing retirement accounts, such as former employer plans, really many types of former employer plans, whether it's a former employer 401k or TSP, defined benefit plan, as well as non-Roth IRAs. So it could be a rollover IRA, a traditional, a SEP, a simple. As long as it's not Roth or after-tax money in that IRA, the rules allow you to transfer it over to our solo 401k plan. So you could consolidate. So now you could have much more investment options, right? Whether it's those alternative investments or just brokerage investments. And we have tremendous experience with helping customers transfer funds from hundreds of different places to their self-directed 401k. As you might imagine, all these different firms have their own unique process typically. So we've tracked that experience in our knowledge base to make it easy for customers going forward to transfer funds over to their self-directed 401k. Back to alternative investments. One of the top investment categories is real estate. Now, it's possible to combine one's self-directed 401k funds with debt. Now, it has to be a special kind of debt, which is called non-recourse debt financing. So that means that the only recourse of the lender is going to be the property itself. In other words, the solo 401k participant can't guarantee that loan. That means that that loan is going to be priced differently. For example, typically, if someone's looking to get non-recourse financing to their self-directed 401k to invest in real estate, they're pretty much going to have to put around 50% down, right? Because again, that lender is going to say, well, my only recourse is the property, so we want 50% down. Now, if someone were to make this same type of investment, in other words, combining retirement money and non-recourse financing via an IRA, they'd have to use non-recourse financing via an IRA also. But a huge difference is if someone uses debt along with their IRA funds to invest in real estate, the income attributable to that investment is going to be subject to a special tax payable by the IRA called unrelated debt finance income tax, UDFI. There is an important exemption to that UDFI tax, though, if someone were to make that type of investment through a solo 401k. So that's a huge advantage, right? Because now the funds can accumulate inside the 401k. The 401k is not going to have to pay tax on the income, in contrast to an IRA that would have to pay tax, UDFI tax, on income from debt financed real estate inside the IRA. Conversions. So our plan allows for different types of conversions, and we provide tremendous compliance support with respect to those conversions. So what are some of the top scenarios where a conversion will come up? Number one would be the mega backdoor Roth. So when one makes a mega backdoor Roth contribution, it's really a two-step process where they're first depositing the funds into their voluntary after-tax account before they get moved over to the Roth 401k. So that first step, the contribution, that's not reportable. It's not reportable on the business return, the personal return. It's an after-tax contribution. But the second step, when you move the money from the after-tax account to the Roth, that is reportable via a 1099-R issued by the 401k. We handle that Form 1099-R preparation and electronic filing as part of our service for no additional charge. And the way that we do that is we capture the information via an online form. So we don't have access. We don't provide our customers accounts. So customers just simply let us know that they processed an after-tax to Roth transfer to give us the information we need to prepare the 1099-R. The second scenario where you'd have a conversion come up is in the context of a pre-tax to Roth in-plan conversion. So this is where someone might be moving over cash or even an asset from their pre-tax solo 401k account to their Roth account. So that's going from a pre-tax status to a post-tax status to a Roth status. So that conversion is going to be taxable. So it's not only taxable, it's also reportable. That's how the IRS finds out about it. And of course, there's an obligation to report. We handle the 1099-R reporting as part of our service for no additional charge. Likewise, there's an online form customers use to provide us the information we need so we can put that in the queue to issue the 1099-R. So as mentioned, we don't hold or have access to our customers' funds, but we're neutral as far as where the accounts are set up, and we're hands-on as far as helping our customers set up accounts. So again, it's totally self-directed. Customers can have an account at a bank. They can have an account at a brokerage. Now, we talked about why customers might want to use a bank account, particularly those who are looking to invest in alternative investments. But it's also possible to have a brokerage account. So you could have both a bank and a brokerage, or maybe even just a brokerage. The top two options are going to be Fidelity and Schwab. Now, Fidelity is number one based on experience and customer feedback. Why? Number one is the onboarding process, right? They recently migrated last year to a streamlined online process, whereas Schwab still has a legacy paper process. So it's just much more streamlined, faster. Accounts are being opened faster. now that Fidelity's moved to that online process. More options with Fidelity when it comes to making contributions, right? You can transfer funds from a personal account, a bank account, could be electronic, could be by check, of course. They even allow you to sync up your payroll service. They've got integrations, right, with Gusto, with Rippling, ADP, Paychecks, just to name a few. So on top of that, of course, then it comes to back to investments, right? So you can make investments and alternative investments from the brokerage account. You don't necessarily need a bank account. Sometimes customers want a bank account just because now they get access to the certified bank checks, things of that nature. But again, you'll get checkbook access with both Fidelity and Schwab. So if you want to make an investment or process a distribution from that brokerage account, it certainly can be done. It can be done by check, it can be done by wire. So Fidelity's process is to go to the branch to issue a wire, whereas Schwab, they allow you to do it online. So that would be an advantage in the Schwab column. But by and large, customers find Fidelity more preferable, but Schwab is definitely a good option. Nothing wrong with it. And again, we're totally neutral. The tax credit, that's great. It's a great feature, really helps to offset the costs. I mean, our fees are already very economical. We charge $650 as the initial cost, which includes the $525 establishment fee plus the first $125 annual fee. Then starting 12 months later, we charge our $125 annual fee. For example, if somebody signs up in February of one year, the annual fee is due in February of the following year. Setting up the plan is going to now makes the self-employed business eligible to claim $1,500 in solo 401k tax credits. That's $500 per year for 3 consecutive years. So that more than covers the cost to set up and maintain the plan for the first 7 years. We were the first major provider to offer it to all of our customers, right? So we've been doing it since the end of 2023. We really launched it once the IRS updated the form that's used to claim the credit. And so for all of our customers, we provide a link to a deep dive webinar we hosted with an IRS enrolled agent that goes through exactly step-by-step how to file the form, or you can share it with your tax advisor, the form that's needed to claim the credit. So just a little bit more on the credit. It is a tax credit, not a deduction, right? So it's a dollar for dollar reduction in the individual's tax liability. Again, that's going to be a great incentive, as it more than covers our fees for the first 7 years. You have to have a plan like ours that includes the automatic contribution feature. So that's what makes the plan eligible for the credit. But the solo 401k participant has the right to opt out of that automatic contribution feature. What it does is it sets a default 3% contribution amount. But the solo 401k participant, again, has the right to opt out of that default. And then that allows them to contribute in whichever amount or schedule they prefer. Doesn't mean they're not eligible for the credit, right? They're just exercising their right to opt out. And the credit is available to not only new plans, but even someone that upgrades an existing plan. Like say you have a basic solo 401k at Fidelity, you upgrade to our plan. Now you're going to be eligible to start claiming the credits. That'll be $500, for example, in 2025. And then again, for 2 more years, as long as the plan is maintained with that automatic contribution feature, which again, you can opt out of. Doesn't mean you don't lose the right to claim the credit. You've claimed the credit by filing Form 8881. Again, we provide a deep dive webinar we hosted with an IRS enrolled agent that goes through everything step by step, how to claim that credit. So if someone upgrades an existing plan in 2025, be able to start claiming the $500 credit when they file their 2025 taxes. And then again, for 2 more years for a total of $1,500. Or if someone signs up in 2025, they'll be able to start claiming the $500 credit for when they file their 2025 taxes. And then again, for 2 more years for a total of $1,500. And then, of course, the support, right? We provide all the ongoing compliance support as part of that $1,500 fee. So what that means is going to vary. Of course, there's going to be mandatory plan amendments and updates, which we provide proactively to our customers. And then other things will depend on what's going on, right? Unlimited free rollovers, the Form 5500EZ, once the value exceeds $250,000, the 1099R, educating customers in terms of the rules, right? The contribution rules, the investment rules, providing loan documents. We provide the support by email, by phone. And then, of course, we have these twice per day webinars, one at 10 a.m. Pacific, 1 p.m. Eastern, and then again at 1 p.m. Pacific, 4 p.m. Eastern. You can always find the links at mysolo401k.net/webinar. All right, now let's go to some questions. Thanks for taking the time to listen, to chat over the questions. Well, so you have Roth contributions, which is typically going to be employee contributions. It is possible to make employer contributions as Roth contributions, but most customers, if they want to really maximize Roth, would just skip making employer contributions altogether and just simply go right to the after tax. So employee Roth contributions are going to be limited, for example, for 2025 to the employee limit, which is $23,500. Whereas you can make after tax contributions all the way up to the overall limit, $70,000. So it's a much higher limit. That's a huge difference. And then it's a different type of contribution. So that's why you need a separate sub accounts, right? So you got to put the after tax money into that after tax account before you move it to the Roth. I'd like to confirm with the professional for this year's filing, the profits from my share of the partnership was $25,800. I plan to contribute $628 to the pre-tax account. I plan to also make a 20% employer profit sharing of $5,160 into the pre-tax account, and then $20,640 as a voluntary after tax. So you still have to make sure that you reduce your line 14 by 1/2 of the self-employment tax. That's how you determine self-employment compensation. So for a business tax as a partnership, you take line 14 of the K1 less 1/2 of the self-employment tax. And then of that amount, the individual can start making contributions. For example, voluntary after-tax contributions, 20% as an employer contribution. And then in addition, they can make employee contributions, assuming they didn't max out contributions to another plan like a day job plan. Also keep in mind that the total amount of contributions to the solo 401k, whether employee, employer, or voluntary after tax, cannot exceed that self-employment compensation, right? You can't save more than you earn. So if you were to go to our website, you would see that we have a calculator. So if you go to mysolo401k.net just go to mysolo401k.net, then on the menu on the right, if you click on learn, and then you go to online tools, that'll take you right to the calculator. And then from there, you can choose the year, you can choose the business type, you can enter here's the calculator here. Under learn, click on online tools, Solo 401k annual contribution calculator. You could enter, let's say the individual's 35. Let's say they have 25,800. Let's say it's a partnership. Let's say 2024. So assuming that the plan was set up by the end of 2024, then the individual can make all types of contributions for 2024. So you can see here, it runs the numbers. It determines 1/2 of the self-employment tax. It reduces it. So that's going to be your self-employment compensation, $23,977.29. 20% of that is your employer contribution. Now, keep in mind that the total amount of contributions can't exceed that $23,977.29. So you could do 20% as an employer, assuming you didn't max out contributions to another plan like a day job plan. You can make employee contributions, and then if there was still unused contributions, you could make those as after-tax contributions. Yes, so we would provide that deep dive webinar hosted with an IRS enrolled agent regarding how to file Form 8881. And there's different sections of that webinar based on how the business is taxed. For example, there's one that's geared towards partnerships. Oh, thank you so much for the positive feedback. How do we benefit from the annual K1? Well, the annual, if you're making a solo 401k investment, an alternative investment, needs to be made under the name and the EIN number of the plan. If that investment provider is going to be issuing a K1, it would need to be issued under the name and EIN number of the plan. So that lets the IRS know that those gains are accruing inside of your 401k on a tax deferred basis. So it's going to benefit you because it's going to be tax deferred. Can my solo 401, thank you for these great questions. Can my solo 401k engage in a multi-member LLC with 5 other friends, acquisition of a multi-family building, 5 million? Are there any limitations on types of financing? Well, the solo 401k owner certainly cannot guarantee any type of financing to the LLC in which their solo 401k is investing. There can't be any other recourse against the solo 401k. So the only recourse, now the other unrelated persons, if they're not related persons, they would be free to personally guarantee that loan. Again, it's got to be totally passive. So the solo 401k owner or related persons cannot work on the property, can't use it for personal use. Hopefully that gives you some good feedback there and considerations. Thank you so much for bringing the good questions and the great participation. Thank you. Again, please subscribe to YouTube. Tomorrow's session is going to be great. It's going to kick off the contribution season in terms of lots of good content. So we really encourage you to subscribe so you get all the notifications. Please feel free to come live and ask questions. So we're excited to kick it off. And always find us here in our community, right? You can post questions 24/7. You can join the webinars, mysolo401k.net/webinar. All right, well, wonderful. It looks like that takes us to the end of the questions. Thank you so much, everyone. Until next time.